This year, as president, I was kind of having the chapter take a look at focusing on disruptions in the commercial investment industry, because I think we are at a turning point this year, potentially in valuation, in activity. It's just something that I've been kind of watching over, and so as part of this year's programs, we wanted to take a look at interest rates. And in the beginning of the year, there was concern that interest rates are going to start increasing, and we believe that that can be a significant disruption to the industry this year, kind of planning how interest rates might impact value, how it might impact transactions, how it might impact what our clients, buyers and sellers, are going to be doing in the industry based on interest rates. So there are three of us who are part of the chapter who would kind of like to give you a little bit of insight from our experience. I moved up here to Oregon in 2010 from Newport Beach. I've been in the commercial industry since 1976. And Fred, I think, is the only one here who's older than I am, and been in the industry maybe longer than I have. But I've been in it for 42 years. I was an industrial developer in the Inland Empire until 1990, 91, when the recession, one of those that I've been through, caused a lot of us to get out of that industry. And in 1994, I went into the brokerage, and I Robin Ellis. 1998, I then moved to C.B. Richard Ellis. And spent about 12 years there. I qualified for Senior Vice President with C.B. Richard Ellis, helped to start the Private Client Group as a concept in '99 in Newport Beach, and ended my career as manager of CBRE's West Coast China desk with my Asian partner, Dennis Zhang. And then in 2010, my wife said she's moving to Oregon, and that's where she was born and raised, and I decided to follow her, which was cheaper than getting a divorce. So I own Oregon Commercial Realty. I do work with C.B. Richard Ellis as an affiliate and with Land Advisors throughout the state of Oregon as an affiliate. And I'm starting off our presentation with the topic: do interest rates affect cap rates and the value of commercial real estate? And this is a derivative of a white paper that I was asked to write in 2007 for CBRE clients, primarily in Orange County, and wanted to kind of update it a little bit and share it with the group here. Again, these are some insights that I have, being in the industry for as long as I have, and from networking with people from San Diego through the Portland market. So with that, we will get started with a presentation. So my assumptions are based primarily on the 10-year Treasury bill, and the used as a benchmark in getting loans for purchasing investment real estate or refinancing investment real estate. And the 10-year Treasury bill is a benchmark. There are other benchmarks that are used today that maybe our lenders here are going to discuss, but my focus has been on the 10-year Treasury for the last 35 years. So here's some insight here. Between 2008 and 2016, the United States generated $10 trillion of new debt. The Fed bought 4.5 trillion of U.S. assets. Most of those was U.S. debt. Created 8.37 trillion of new U.S. dollars in circulation, most of it electronically. We didn't print $8.7 trillion. And because of that, interest rates dropped below an 80-year average cost for the 10-year T-bill. And I think most of us are aware that the Fed has been active in trying to manipulate the U.S. economy with their money policies. As a result of this, debt holders who held debt prior to this have taken on 2 times as much risk, because the amount of U.S. debt has doubled in that period of time, but they've accepted a reduction in the interest rates. which is really interesting. So if you're holding T-bills and you're, whether it's domestic or international investors holding T-bills, your risk as far as the United States just doubled because of double the debt, but you were willing to accept a reduction of interest rate or yield on that. So in looking at this, can interest rates move higher fast enough to cause significant reductions in real estate value? And this presentation makes the assumption that it could, and that we need to take a look at how that might impact our clients. The money supply is something I study in graduate school in Los Angeles, not UCLA. The money supply in 1900 was basically $7 billion. That's how much money there was in circulation. 1990 is 1.56 trillion. If you take a look in 2010, as we're coming out of the recession, the money supply from 2000 to 2010 went from 3.2 trillion to 4.9 trillion dollars. And most of us in the room might remember the 2000 to 2007 market, where it was very frothy. We had a lot of people who had what they considered historically to be cheap money, especially when the 10-year treasuries were, in the 3.5% to 5% range. It was starting to come up. We all thought that that was cheap money at that time. We hit a recession, and through the next 6 years, through money policy, we added approximately $8 trillion of money supply to the economy to impact interest rates. And interest rates, as we will see, were driven lower. This is 1,900 times more U.S. dollars in circulation than in 1900. And this also is demonstrating that the Fed is trying to manipulate the economy, and in that may have manipulated real estate values. The average annual 12-month rate, and this is 12 months for any or interest rate for any 12-month period of time, dropped to an 80-year low of 1.88% in January 2015 during this money creation process. The average annual rate was 2.96 on April 27, 2018. The 10-year T-bill rate today, I think, is somewhere around 2.5, 2.55. But again, these are average interest rates. So asking the question, can interest rates move quickly in today's market? Well, in March 2004, when we were going through that very active period of time, T-bill rate for the year was 3.82%. In June 2007, it went up 1.3% to 5.11. Then if we remember rightly, in August of 2007, we had the European impact from the mortgage debacle, and interest rates really started to move after that point in time. But in 2016, the April's average T-bill rate was 1.473 at the end of the Fed action, when they created $8 trillion of currency out of thin air. So we're starting to see interest rate movement now, but we're seeing it at a different level. And this graph will show you the 80-year average, if you can see it. The 80-year mean was 4.77% for the 10-year Treasury, but because of the Fed action, we're not starting at a mean rate or just a little bit below the mean rate. We're starting at 200 basis points, that yellow line, below the mean rate. So what that means to me, in my observation, is that if there is an interest rate movement, we have 200 basis points to go before we get to the mean rate. And then if you take a look at the 1960s and 1970s, there were some significant movements in that interest rate. And I'm not talking about the peak, I'm just talking about those movements when we had similar money creation under Arthur Burns, similar money creation issues that caused economic challenges during the late 60s and 70s. So, and that's reflected here. Interest rates moved up in a 5-year period of time, approximately 3 percentage points above the mean. And we are 2 percentage points below the 80-year mean. To me, what that's reflecting is that there may be an opportunity to move in the next 5 years 5% above what the current 10-year T-bill rate is today. So T-bill rates could go from 2.5% to 7.5% in 5 years, and historically, that's something that's happened before. So economists that I've been reading are suggesting that interest rates are going to go up to 3.5% for the 10-year T-bill rate by the end of 2018 and maybe 4% by the end of 2019. As we saw, history has shown that interest rates can move pretty quickly. Do interest rates, again, mean that there is a change in cap rates and a potential change in real estate value? Back in 2007, there was an economist for CB Richard Ellis that suggested, and this is before the latest money creation, that anytime we have historic low rates and property values and historic high square footage prices, investors need to decide to sell or to keep their assets. And part of his contention is that the Fed has, through their money supply, given as a gift equity in real estate. And so he was saying that selling may mean paying taxes, but if cap rates move back to a normal range, the tax liability is still there if you don't sell. You've just lost that gift of equity or gift of value in the real estate. So it's something that we as practitioners need to look at and study and help our clients, whether buyers or sellers, understand what that relationship might be. So do interest rates affect cap rates? This is one way of calculating cap rates. It's a simple way to take a look at what cap rates are. There are, from what I understand, hundreds of different ways to calculate or to look at what a cap rate might be. The simple way is that cap rates are a value determiner that investors might use to determine what they'd be willing to pay for commercial investment real estate. So under this formula, you take a look at a leveraged purchase, which is a loan that somebody might be getting from one of our lenders in the room or up here, and there's an interest rate that is charged for that loan amount. And as that interest rate, is it adjustable or is it fixed? Those have an impact to it. This formula just estimates that it's a fixed rate. You add the loan to value times the interest rate plus the equity that somebody's putting into their property, and in our assumptions, most of it's 25%. And that equity that an investor puts into their investment has a rate of return that they're looking for. They're expecting a certain rate of return for generating a cap rate. So if you have a 75% loan to value at 4.5%, that would be a 10-year T-bill today plus 200 basis points plus 25% down payment where the investor wants 8.5% return. That generates a 5.5% cap rate under this simple cap rate determiner. So I wanted to use a real-life example. Hopefully you can see that. A real-life example, this is a property in Southern California that was a strip center. It had some regional anchors in it. It's anchored by a Target. And this is a recent sale at a 5.5% cap rate. The rents are real rents. It's triple net. So this is an easy way to take a look at how a cap rate determines what the value is for this particular property. And it sold for $19 million, approximately $380 a square foot in a very nice neighborhood. Not the highest neighborhood, but a nice neighborhood. So that may have had some impact on the cap rate. Again, the cap rate that we saw before demonstrates that the person who was purchasing this property was looking for an 8.5% return on their equity. Hopefully you can see this as well. That same example is on the top, but what effects do cap rates have on the value and what affects the cap rate? So if we were to just change one of the assumptions, which is the investor anticipating that there's a change in interest rates coming, and maybe it's a significant change, they may want a higher rate of return on their capital investment than 8.5%. Now, in the first or the second line there, the lender is still satisfied with 2 basis points over the 10-year T-bill rate, but the cap rate moved a little bit to 5.88% with just one assumption change, and that caused a 4.3% reduction in the value. It caused $1.2 million reduction in value. Now, there are other examples here. The next one is, well, what if the T-bill rate goes to 3.5%, but everybody else's assumptions stay the same? The cap rate will move to 6.25%. It's a pretty significant move, and the reason for that is that we are in a compressed cap rate market today. Everything has been pushed down so tight to the bottom of cap rates that anytime you have an adjustment upwards, that adjustment is a little bit more severe than the way down. It comes up faster than the way down as far as how it affects the value. So we have a 12% move in value change just based on changing the interest rates if the investor was satisfied with an 8.5% rate of return, but interest rates go up and their cost of debt goes up. One interesting factor is on the line next, one up from the bottom is, what if lenders change their loan-to-value ratio from 75% to 70%, but all the interest rates just change the same? There is an impact to the cap rate because you now have more equity that is now looking for an 8.5% return than for a 4.5% return. So your value changes just when the loan-to-value ratio changes, and again, that's come down by 3.5%. So from this example, it appears as though interest rates can affect cap rates and may have an impact on the value. Going a step further, usually one of those assumptions does not change without impacting the assumption of some of the other influencers in the cap rate. So if T-bill rates start to change, does that mean that investors are now thinking, I need to get a higher rate of return for my money, keeping the delta or the difference between what the lenders are receiving and what an investor wants? So it has a tendency to have a compounding effect, at least historically, that if interest rates change a little bit, the investors' return on investment changes a little bit. Lenders might get a little bit more anxious, so their spreads will change a little bit, and they may even get a little bit more nervous depending on the type of investment, so their loan-to-value might change a little bit. The next thing you know is you have a compounding effect, and interest rates can force changes in cap rates significantly by looking at this chart here. In my career, having cap rates in the 4 to 5% up until just recently, we never saw that. In the 80s and 90s, all the way up into the beginning of the 2000s, cap rates at 9, 8.5%, 7.5% were cap rates that we saw regularly, even higher when you had the changes in the early 80s. So we've seen historically cap rates get compressed down to historic low levels, forcing the per square foot pricing of real estate to levels that have never been seen in various communities or in various asset types. This shows that there could be a significant change in value if interest rates were to move. Again, it's not predicting that that's going to happen, but it can happen. So if we're seeing some interest rates move and we're seeing cap rates change, we need to start to educate our clients as to what the probability of value change may be. This is just kind of something that if interest rates just move from 5.5% or cap rates to 5.88%, it requires a 6.9% increase in revenue or your NOI to offset that loss of value. And again, in the beginning of my career, we saw leases that were 3 to 4% increases per year, keeping up with what anticipated inflation was when inflation was really calculated correctly. Now it's not calculated the same way as it was, and we also have in our leases the expectation that lease rates will only go up 1.5%, 2%. I've seen some where that leases that are fixed for the first 5 years, and then they only go up 2% after that. It's a reflection of the expectation that inflation is going to be kept low, or at least identified to be low, and that costs for your debt is going to be low. So a lot of the leases in investments today may not have escalators that will keep up with the change in value. As you can see, if you move from 5.5% to 6.85% cap rate, you have almost a 20% loss in value, but it's going to require 24% increase in your revenue just to keep up with that value. Many of us can't. Yeah.
I have a question. For the first time ever, I actually did, rather than a graduated increase like 3% to an industrial rate, I did a lease that was CPI. How is it better to follow CPI in this case?
Well, it can be better, and certainly it's recommended, because you have, just from what I understand, you have real inflation and you have reported inflation. And anytime the government is telling me that an inflation rate is at a certain level, it's never been my experience that that's been correct. When you're looking at, the way they calculate the CPI index and the way that they calculate inflation today, especially when the way that they're using housing cost as part of the inflation. So it's, in my career, it's always been best to have that escalator based on the CPI index of the community that you're in. It still doesn't allow you, by the way that they're reporting CPI, to keep up with the potential changes in the value and the revenue that you need, NOI revenue or gross revenue that you need to keep up with the value of that property. So kind of in summary of this part of it, commercial real estate assets with long-term fixed rate assumable debt are going to maintain their value longer than assets with that expires in the next 2 to 5 years. And those assets that might be commercial, might be retail, might be industrial with shorter term debt have a higher risk factor for reducing value than a multifamily property with assumable debt at historic low fixed rates. So this is why we're seeing, in my opinion, people still buying multifamily properties with fixed debt that might be assumable once or twice, where they know in their exit strategy that they're going to have value just in that cost of the debt that they've been able to secure at historic low rates. Asset classes with short-term bank debt are going to feel the value change faster and require more capital contribution, and I think our lenders here are going to suggest that could be a risk factor that we all need to be aware of. And finally, investment properties that have only 1 to 2% increase in annual rent are going to be farther behind the value curve, because you can't keep up with the changes in inflation or with the changes in your cost of debt if you have those types of terms in your lease. So with that, we're going to turn it over to Steve Mensch, who has a point of view from his experience.
Thank you, Mark. Thank you, everybody. Appreciate the opportunity to speak to you today. My name is Steve Mensch. I'm with Mensch Real Estate Capital. I'm a commercial mortgage broker, have been for a long time. I come from Florida, originally from upstate New York, but from Florida for 30 years. And like Mark, I followed my wife out here. So we have that in common. First thing I want to do is cover some evidence of rising rates. This is a graph showing the LIBOR rate, which is a short-term index that's used primarily in construction loans and bridge loans. This is going back to 2013. I wanted to show you how flat and stable it was for so long. And then in 2016, it started its climb. This is the LIBOR rate increase in the last 12 months. This is a 115 basis point increase in the LIBOR rate. And just to put some facts with that, let's say you're an apartment developer and you have a $20 million loan. This rate increase cost you $250,000 more in interest charges. The next index is the 5-year Treasury. Let's say you're that real estate developer and you're coming off your interest-only portion of the loan. You're stabilized. Well, now you're into you can flip into a mini perm. You can rate lock. You can have principal and interest payments. Well, the 5-year Treasury is the index that would be used to figure out that interest rate. Not quite as much of an increase as the LIBOR. You'll see 95 basis point increase in the last 12 months, but still a sizable increase in the last year. And the last index is the 10-year Treasury, which Mark alluded to in his talk. This is primarily the index used for long-term mortgages, for investors who are looking to purchase a property, hold it long-term. Perhaps it's a non-recourse loan from Fannie or Freddie, something like that. So this 10-year index is very important for those type of investors. And this rate increased 65 basis points, or 0.65% over the last year. Again, a little bit lower than the 5-year. So we're seeing a trend where the short-term rates are rising quicker. The long-term rates are not quite as aren't going up quite as much. And you might be reading some articles out there about the yield curve flattening. There's some economists who are watching that. The next step would be inversion of the yield curve, where that's a predictor of a recession coming. Anybody who wants to be a nerd like me and watch rates every day, you can go to my website. If you're interested, I can send you a link to this page. All the major indexes that are used in the industry are here. So clearly, rates have gone up in the last 12 months, and considerably they've gone up. So are they going to continue to go up, or are we done? By and large, the word out there is rates are going to continue to rise. Here's a headline from Bloomberg News. The Fed's leaning towards raising rates 4 times. Keep in mind, the Fed rate raises the LIBOR and other short-term rates, not necessarily the Treasuries. But we're going into more debt as a nation, right? We had this thing called a tax cut a few months ago, and we're also increasing our spending. Our deficit is forecast to go up. We're actually going to be issuing more Treasury debt in the coming years. And anytime you increase the supply of something, you might have to entice buyers to buy it. So therefore, it's expected that Treasury yields will go up to entice buyers for that debt. This is sparking some headlines now. There is talk about cap rates rising. So, the subject that we're discussing today is happening, is being discussed. This is an article by Green Street Advisors. They're a advisory firm down in Los Angeles. They advise pension funds and big institutions. Here's a headline from last week. Are rising mortgage rates going to threaten the U.S. housing market? So that brings us to the crux of our talk, which is, will rising interest rates cause cap rates to rise and therefore properties to fall? And I'm taking the contrarian position from Mark that no, the cap rates are not going up yet. And I have evidence to share with you, at least on the institutional side of things. And preparing for this talk, I had to go back to grad school and think about some concepts that I learned there. And one of the few that I still remember is the vertical stack of a cap rate. So this is an example of an apartment community that might have sold last year at this time. So imagine April 2017, somebody bought an apartment for a 5% cap rate, right? It seems realistic. Back then, the 10-year Treasury, and we're assuming a 10-year investment horizon for this investor. So if you look there, the yellow is the risk-free portion. That's the 10-year Treasury. At that time was 2.35%. And if you assume the 5% cap rate, you can calculate that the risk premium is 2.65%. And this kind of goes to the alternative investment theory, where if you have $10,000 to invest, or $1 million or $100 million, you have many different places to invest the money, right? You can keep it in a bank and never lose your principal, but then you have the risk of losing your principal due to inflation. Or you could go up a little bit in the investment spectrum to treasuries, which gives you a yield and is considered the risk-free investment. Then you can go to government bonds, corporate bonds, and then commercial real estate fits in there, maybe an S&P 500 stock, and then venture capital. Each one of those investments has a risk-free component because you always can invest it in treasuries. and each one of those investments has a risk premium on top of that. Now, venture capital would probably be 4 times that premium that we see right there, right? So let's fast forward to 2018, where we know that the treasuries, the same 10-year treasury now is 3%, right? So if we assume that investors' risk premiums are static and do not change, then you take 3% plus the 265, well, the cap rate has to be 5.65% for that same apartment building today, right? Well, no, not really. This is a chart, very busy, I know. This is published by NAREIT. NAREIT is a trade organization that includes life insurance companies, pension funds, real estate investment trusts. And they basically share all their information. They share what they paid for a property, what cap rate they sold a property for. And all that information, national information, goes into this database, and they can view it and make sure that, hey, we're in line with our competitors or we're not. And what this shows you is cap rates in the last year have been flat by and large. It says up there that cap rates fell 5 to 20 basis points for apartments, office, and hotel properties, but they rose 4 to 12 basis points for industrial and retail. So really a wash, right? So if cap rates haven't gone up with interest rates, what happened? Well, this is the, remember back here I showed you the red part? That's the risk premium. This is a graph that shows you just the risk premium for all those properties that sold through NAREIT. And look at the very right side of the graph, you'll see it drops off. So basically, investors in real estate that participate with NAREIT are willing to take a lower return for the same assets, basically. And I think that speaks really well for our industry, that the institutions still want to buy commercial real estate. It's still a sought-after asset. Maybe they think there's rent growth. Maybe they think commercial real estate is a great inflation hedge, which Mark alluded to, which it is. Or maybe they just need to invest 20% of their portfolio in commercial real estate, which a lot of them do, and they're forced to invest at these lower cap rates. So let's look at, so this is reality then. Instead of the risk premium staying the same, the risk premium has shrunk. So we're assuming that apartment project in Portland is going to sell for the same cap rate, so the risk premium is lower, right? And then if we look at my last slide, this is just showing you where we were in 2017, where we are today, and then look at 2007 when we were in our last spike. Now, there were a lot of crazy things going on back then. We had 10 years interest only. We had lenders underwriting to future rents, so there was a lot of crazy stuff going on in the market. But look at the risk premium back then was 80 basis points. The treasury was 4.7. So, my theory, and I'm just trying to play devil's advocate to Mark, is there's still room for that risk premium to shrink based on history. And maybe cap rates won't go up as much as we think. So my last slide disappeared, sorry. So basically, the one caveat I have for the information I presented to you is those are institutions, right? Those are the big boys in our business, the pension funds, the life companies are buying 30, 40, 50, $100 million properties. They may not even put debt on their properties, so maybe debt doesn't factor into their analysis quite as much. Your mom and pop who's going to the local bank and suddenly their interest rate's 100 basis points more, they're buying a 10-unit project in Beaverton, they may be more affected by interest rates than the big institutions. So, but, the big players in our business don't seem to be affected yet. So with that, I give it to Isaac.
Thank you, Steve, and thank you, Mark. My name is Isaac Grant with Northwest Community Credit Union. I'm a commercial real estate lender. Our credit union has been serving our beautiful state of Oregon since 1949, when 6 Weyerhaeuser employees put $50 in a lunchbox. And today we're a little over $1 billion in asset size and strong in the local commercial real estate market. To make it a full house, I too moved to Oregon for a woman. Yeah. In my case, it was to seal the deal. I think it was around the time I moved here that Beyonce coined the phrase, "If you like it, you should put a ring on it." And so I took that advice straight to heart and made sure that I did so. What I want to do as a way of just kind of wrapping up the presentation is to take a little bit of a look at the local perspective. How are lenders in your local communities, maybe some of the secondary markets in Oregon, beginning to interpret the anticipation of a rising interest rate environment? And this question is one that I've maybe just started to hear over the last 6 months or so. Kind of this became a question in the fourth quarter of 2017, and definitely in the last couple months. Folks have started asking, especially in our local lending industry down in Eugene and Lane County, are you guys starting to change your underwriting standards? Are you changing the parameters? Are you lowering your loan to values? Are you changing policy and procedures? And so we're going to take a look at a few different parameters to speak to that. I think just at face value, the answer would be no, but the lower cap rates are driving some potential changes in the way that local lenders are underwriting some of these commercial real estate deals. So we're going to take a quick look at loan-to-value, debt service coverage, and sensitivity analysis. Obviously, those are only a few. Other ones we could consider would be things such as debt to net worth, a global debt service coverage, secondary sources of repayment, the liquidity of borrowers. There's obviously much more that goes into it than just this, but these kind of seem to be some of the major ones that interest rates are very much interconnected with. So what I wanted to do was provide maybe just a snapshot underwriting example for my fellow lenders in the room. This is going to be just a little bit of review as to what most lenders are going to be looking at when we receive your guys' marketing packages from brokers, and we're taking a look at an initial package on some financials. But this is kind of a live scenario that I took from a deal that I received last week. I rounded some of the numbers to make sure that it wasn't completely copying what I received on a marketing package. But this is kind of the typical deal that we would take a look at. I will say that so far in 2018, we have not closed a deal at 75% loan to value. We made no change to policy and procedure. We will still do loans up to 75% loan to value. In some cases, some property types will even do 80% loan to value. With our SBA partners, we'll do the 90%. But what we are seeing is the squeeze on those cap rates is affecting mainly the debt service coverage. And that's kind of the number here that I wanted to illustrate. So at a $1.5 million purchase price, if we were to lend at 75% loan to value on a 25-year amortization at a kind of a conservative 5% interest rate, our debt service coverage would only be 1.09. The cap rate is a 5.8, which is pretty typical at the moment for the Eugene market. And then the other number that I identified there was the debt yield. Some lenders like to take a look at debt yield. I think a lot of lenders in our market do take a look at debt yield. That is the net operating income divided by the overall debt on the property. And that kind of gives lenders a good look on their cash-on-cash return. Most lenders conservatively are probably looking for a debt yield around 10%. We don't have any specific numbers on debt yield for us. But most lenders, as just kind of a general rule of thumb, are going to be looking to get a debt yield of either twice their interest rate that they're charging or 10% as a good guideline. So obviously, with this deal, 75% loan to value is probably not going to work for most lenders. Again, does that mean changes have been made to policy and procedure? Most likely not. However, it's going to be difficult for an investor to only put 25% cash down on this kind of deal. As we move it forward, now we're going to take a look at debt service coverage at 1.25. Cap rate obviously has not changed. It's still producing the same level of net operating income or cash flow available to service debt. But we've moved to kind of a general industry standard of a debt service coverage of 1.25. What you'll notice here is at the same interest rate of 5%, your loan to value is going to change to about 66%. So that's a 9% difference, and what that means in real numbers for your client, for your buyer, is an additional cash down requirement of $140,000. It does mean that the monthly payment difference has decreased by $824, but obviously your investors had to put in more cash to be able to lower that monthly payment. So they will make that money back over time, but most lenders are going to want to see that equity component being injected at the start of the deal in order to move forward. So this is kind of a pretty typical common snapshot of what we'd be looking at for a deal at around a 5.8% cap rate. Now, there are obviously different property types, and different lenders are going to have different debt service coverage requirements, so they're going to have different debt yield requirements depending on that property type. So a 125 is going to be very typical for maybe your smaller owner-occupied space. It's going to be very typical for some of the mid-size multifamily stuff under the 2 to 5 million mark. Obviously, the larger you get, the more single-use property you get, the shorter-term leases of tenants, that debt service coverage requirement may increase. And so, again, that's going to have an impact on your buyer to need to come in with some additional cash down. Sensitivity analysis and stress testing. So as we're in this rising interest rate environment, what you're going to see a lot of lenders do, and some are more conservative than others, is begin to take a look at if interest rates do rise, what level of debt can this property support if the variable interest rate were to rise. So again, kind of plain vanilla terms, most lenders are going to fix your rate for 5 years, whether that be on a 5-1 arm or a 5-5 arm. Some lenders will offer a 3-year fixed, a 7-year fixed, a 10-year fixed. But for kind of just base level terms, most lenders are going to fix that rate for 5 years. So when we start looking at some stress testing and some interest rate sensitivity, if interest rates were to move up 2%, to 7%, again, the same level of net operating income, to meet a 1.25% debt service coverage would mean a loan amount of $813,500, which again means much more cash coming out of your buyer's pocket. I only know a few lenders that are working off of this conservative level of underwriting, but it is out there, and it may become more common as interest rates begin to rise, that more cash down up front is going to be required from buyers in order to get loans on the property. So you can see there again, additional cash down required is going to be $311,500. And again, you are going to have a reduction in that monthly payment, but it is reflective of a 54% loan to value. So it's a big investment on the buyer's side, but that debt yield is now up over 10%. So that's where most lenders would feel comfortable in these kind of scenarios if debt yield is one of the parameters that they typically want to take a look at. Now we'll take a little look at some break-even analysis. So the previous slide, as you'll see, was at a 1.25% DSC. Now if we just look to break-even at a 1-to-1, it won't require as much cash down. The debt yield is going to be a little bit lower for the lender, and you will have an increase in your monthly payment compared to the 75% loan-to-value scenario where it was a 5% interest rate. This, again, is maybe a little bit more common level of stress testing that lenders are going to be using, is to see, okay, if there's a rise in interest rates, if we have a 200 basis point interest rate increase over the next 5 years, what's the break-even point going to be that this property is able to support in regard to a debt load. The other interesting thing to do, if you have a good amortization table calculator, you could take a look at 5 years from now. Say you get a loan today at 5%. It's fixed for 5 years. You could take a look at your amortization schedule at 5 years from now, take a look at what the debt would be at that point, and then kind of plug in a new interest rate and over the remaining amortized term. So on a 25-year amortization, at 5%, you could take a look at what the principal balance would be 5 years from now, increase the rate to 7%, and amortize that remaining balance over 20 years. What you'll find is it's very close to the 7% interest rate over 25 years. So, yeah, these are very good things to consider when you're working with your buyers and sellers as well. It's good for your sellers to know because they're going to want to see those loan approvals coming in maybe a little bit quicker from buyers. They're going to want to vet their buyers a little bit quicker because, again, if it's taking all of the liquidity out of your buyer because they're needing additional cash down to make the deal work, you're going to want to make sure that they have some cash reserves so that they're actually going to get approved by that lender. Just because they have the cash to put down, 35% doesn't mean that they're going to get approved by a lender. Last thing I want to take a look at is one of the interest rate indexes that a lot of your local lenders are going to use, which is Federal Home Loan Bank. This is Federal Home Loan Bank of Des Moines. It's a rate that we use typically, the 5-year fixed rate advance. Federal Home Loan Bank, I got this data from their website, and it only goes back to the early 2000s. So this is kind of looking back over the last 17 and a half years. Really interesting. We're going to see the month of May come up quite a lot here in the next few, but the highest point for Federal Home Loan Bank was 7.76 in May of 2000. Just before the recession really kind of took its hold in May of 2008, we were at a 4.46, and the rates leading into the recession were in the mid-4s to mid-5s. The low point was 5 years ago today. I thought that was really interesting when I looked this up. 5 years ago to the day today, on May the 1st, 2013, it hit its low point, and I believe that's an all-time low, but I couldn't quite verify that data, but it's definitely the lowest it's been since the year 2000 at 1.04. And as of yesterday, it was 3.1. As of this morning, it was 3.11. So we've had a 0.85 increase in the last 12 months in the Federal Home Loan Bank rate as well, which kind of goes along with some of the information that Steve shared on the various rate indexes. I think we want to leave some time for questions, so I'll pretty much conclude with that. But the important things to keep into consideration with your buyers, especially in an interest rising rate environment, will be things such as checking to see if your loan has yield maintenance covenants in there. We don't have yield maintenance covenants in our loan, but obviously if you're working with a lender that does include yield maintenance, the prepayment penalty for a loan with yield maintenance on a higher interest rate is going to cost them more to get out of some of those loans. Development loans with fully variable rates. We talked a little bit earlier in the marketing session. I think Andrew made reference to prime is at 4.75. So any of your development loans that are tied to prime on a short-term rate, and you're building in those interest rate reserves for your construction deals, you're going to want to take a look at those a little bit more carefully. You're also going to take a look at making sure that you're not being offered a short-term rate on long-term debt. Short-term rates seem to creep up quicker than the long-term rates, and so you're going to want to make sure that you're not being offered a rate that's typically used for short-term debt on one of your longer-term deals. So with that, I think we'll conclude, and I don't know if I'm handing back to you, Mark, or if we're just opening up for questions to the room. And
Are there any questions?
any questions?
Isaac, since you're working with. I just wanted to ask you, Isaac, have you seen any noticeable change in the default rate on any construction loans or any apartment loans?
No, not currently. Default, we don't have any defaults currently. We don't have any delinquencies currently on our debt. Obviously, we have probably stuck a little bit more conservative as a community lender. It's not shareholder money, it's our local members' money. So we typically stay a little bit more conservative, but no, we've not seen an increase in default rates.
No, it's for you.
I was just going to say,
I'm just helping with the
so when I have a client that says, I'm going to just hold on to my cash for when things go bad, so that I have more money to take advantage of that, what should my argument back to him be?
Mark, I didn't hear the last part.
I said when they tell me that they want to hold on to cash and close on something and just not reinvest it so that they can take advantage of when things happen down the road and they have more cash then to take advantage of it, what should my argument back to them be?
In my opinion, some of my clients that made the most always found the right time to sell and hold cash. And sometimes it was 2 years, sometimes it was 4 years before they were able to get back into the market. And they made their biggest equity moves by buying right and having cash. So I can think of one gentleman down the lower desert who he purchased a piece of ground and sold it to Landmark to build multiple golf courses that are down there now, but he reinvested that 3 years later into a lot of industrial properties in Phoenix and the Inland Empire, and basically tripled his money. So timing we can't really figure out, but it's a valid concept for a portion of your portfolio.
I would tell him he might be waiting a while. I mean, who knows? It could be 2 years before we hit another recession. I mean, everything I read says we're far away from a recession. We're easily a year and a half to 2 years away from any recession. So that has to happen first, right? So then the recession has to hit, and then values have to go down. So you got to wait another year or two. So he's probably 4 years away from investing. You want to answer that?
I've got a question for you. In looking at the risk premium that institutional investors, they seem to be taking a little less in return. Are you seeing that lenders and their spread is adjusting a little bit? They're taking a little less return as well?
If I may answer that first. So typically when the indexes move, lenders don't do anything. Like if they move quickly and they adjust back, lenders don't do anything. They might make more profit. If they have a loan under application and the treasury all of a sudden spikes and you got to close the loan and lock the rate, they'll enjoy that increase in the index. But when indexes typically are not coming back down, when they stick, lenders will sometimes lower their spreads and bring down the overall interest rate. So yeah.
Yeah, I think most lenders in our market are going to be want to still be competitive with the what rates are doing in that market. And so, for example, in 2013, when we're in the low ones on FHLB, our spread was probably 3% above the index. Now, when we're at 3.11, I believe, and a good interest rate's probably 5%. We're at 1.9 on a spread. So I think it kind of fluctuates with the market to fuel that economic growth and make sure that everyone's still able to do deals.
In 2005, 6, and 7, we saw spreads change from 200 basis points, 220, all the way down to 75 to 80 basis points. And then I remember coming back from vacation, August 2007, all of a sudden the spread went from 80 basis points to 400 to 500 to 1,000. And so the lenders have the ability to choke off, any debt that they want to as they underwrite the market and change what their expectations might be for that. So that was the biggest change for us at CBRE in 2007 was we couldn't get deals done at the application rates anymore. And so it changed values pretty significantly at that point in time.
Hi, you guys are keeping track of a lot of things that affect cap rates, and one of those things I've been looking at is depreciation and the new rules for bonus depreciation. And so far, I haven't found anyone that really has an idea of how that's going to affect things. And except for Jonathan over at Bedford, and
ratios are going to shoot up quite nicely. Certainly in the first couple years of service is the short answer.
So the other thing I was looking at is the effect of the tax changes and the ability to take a 20% reduction in your taxes on partnerships, which I'm coming to find out is just owning it in an LLC. What are some of the other things, or maybe expanding on some of these, that might be changing our risk premium and the projection for future value increases on property?
Well, I think that I think one reason why institutional investors are willing to take a lower risk premium is because the economy is rocking, right? And rents are going to go up. They're going up. So I think, it's an inverse relationship between rent growth and a cap rate, right? When you see this all the time in Portland, people are buying market rate apartments where maybe the current owner didn't keep the rents at market, and they're maybe 20% below market because they didn't want to move tenants in and out. They were just happy with what they had. You got a buyer who comes in there and pays a 4 or 5% cap rate because he's expecting to raise rents overnight, right? So I think that's part of it. The tax change, I don't know what effect that's going to have. It should have some, right? But
there's several points. As you get a 20% reduction for your partnerships, and then you're getting that automatic reduction. So it's turning into quite a bit. It's 8, 9, 10%, and that goes straight to risk premium, right? So I'm looking at, once this sinks in, this is a room full of really smart people, and we still haven't gotten our minds around it, let alone the rest of the market. But when we do,
that may be a reason why cap rates haven't gone up. Yeah, you're right. Yeah.
Yeah, from my experience, and you're underwriting a property, I would say probably more sophisticated than a lot of family offices, a lot of investors, et cetera. There are a lot of tools that are available now that can take that into account, and certainly becoming familiarized with some of those tools and talking to, people over there like Mr. Frizzell, who, have helped several of my clients increase their cash flows, is something to take a look at. One thing that I've noticed from 2005 on is that people who are buying real estate are not necessarily underwriting what that real estate has to look like for the buyer after them. And we used to underwrite that when we were valuing real estate. We would say, okay, you're going to buy it, and this is your internal rate of return. The person that you want to sell to 5 or 10 years later, what is it that they're going to look for? What's the economy going to look like? What, are their returns going to require, given interest rates move one way or the other? And that impacts your internal rate of return. So that's something that I think the market's going to get back to. It's just not buy and trade, but it's going to be the right time, the right price, and then what can I sell it for, and why is that buyer going to buy it looking 5 years down the line from what they're doing.
So the changes in the 1031 exchanges and personal property was also another thing. I know there's one or people in the crowd. So what is the period of time that we should be looking at holding this piece of real estate so that a 1031 buyer down the road, when they take our property, doesn't affect us negatively on our personal tax situation?
That's beyond my pay rate. I can't answer that one. David, are you in here?
I'm right here, but it's just all your return on investment. It's going to be whatever's best for you. As far as going forward, if what we had happen before is the market just stopped. Nobody could finance anything, right? So of course values dropped when you couldn't do that. So as far, we're talking about refinances today. I've got lots of clients that are refinancing today at the rates because they know, they're anticipating they're going to go up, right? So you got to deal with it, what you've got, and as opposed to if you give up the property to an exchange. We always looked at it. I was always taught it's like every 3 to 5 years you get into it, your equity increases to a point where you can't afford to keep it anymore. So your choice is exchange or do a cash out refi. So, Toya's over here. I think she'd probably echo my sentiments. We have people that are having a hard time, finding things these days, probably more transactions that are just sort of washing out because of lack of suitable replacement. Or we've got people doing more creative transactions because they can't find what they really want, so they're going to create what they want.
Got one more loaded question for the lenders. So would you suggest at this point in time that investors should be securing long-term or 10-year debt as there's this upward pressure on interest rates?
You're talking about getting a 10-year maturity on their loans?
Versus a 5-year. Getting a fixed 10-year kind of as a hedge against upward pressure on interest rates.
Yeah, again, similar to David's response, it's about your risk tolerance. So the 10-year fixed rates, I'm seeing those go away quite a bit in our market. Most folks are only going to fix for 5 and then fix for an additional 5 on a 5-5 arm. The 10-year fixed rates that are out there are pretty high. So again, it's just who has the better 8 ball as to what's going to happen within the term of that loan.
Yeah, absolutely. And that's a lot of what I do, right? So, CMBS, life company, and agency are the sources for that 10-year money. Rates right now are, kind of in the 4.25 to 5.25 for a 10-year mortgage right now, non-recourse. So, yeah, absolutely. I would recommend anybody who can go long-term or even on a construction loan. I'm seeing some of that where you have a fixed rate on a construction loan. It might be a little bit higher than where it would start if it was floating, but at the end of the day, it'll probably be a better decision.
The other thing is the exit strategy for that investor, because some are looking to sell within the first 5 years, and so taking the lower rate initially, and I saw that a fair bit last year when rates were still in the low 4s at some points, that folks were taking the 5-year rate over the 10-year rate because their exit strategy was to continue leveraging up every 3 or 4 years.
Can we answer your questions afterwards? Time is up. We have, did we ask if there were any guests in the room that needed to be introduced by some of our members? Would somebody like to introduce a guest? Maybe they're already gone. Yeah.
I'm Lane Lowry. I'm a developer here in town. I build multifamily, and I just wanted to drop in and hear about cap rates and meet you guys.
Great. Thank you. Meet Nick over here. Okay.